Hello, this is Mike Swanson. I run the website wallstreetwinner.com, and the odds are that you are watching this video because you found out about it from a notification on my email list. Now, if you're not on the email list, then you get on it so you can get all my morning updates before the stock market opens. There's a link associated with this video for you to do just that. And today has been an incredible day in the markets, a surprising day in the markets, because this morning the Federal Reserve did an emergency surprise 50 basis interest rate cut. What does this mean? Why are they doing it? That is the topic that we must talk about together. Let me see if I can quickly share my screen with you so you can see what I see. The price of gold is up $50 an ounce. The price of gold now seems certain to head towards its next critical resistance level at 1710. I know gold dipped last week, but that was a fake out move. Today's action shows us that it was a fake out move. But the Dow yesterday was up over 1,100 points after having taken the biggest point tumble over the course of a week in its history. The U.S. stock market was down close to 15%, the various averages last week, but yesterday there was a turnaround. Now, last week, when the market was falling, there were people out there saying that the Fed should lower rates, they should take action to force the market up. But yesterday, the market went up. So there really wasn't a reason from the standpoint of what the market's doing for the Fed to have to do an emergency cut today. Now, when they announced the news of the cut, the Dow and S&P went up immediately. Gold went up immediately, but within an hour, the Dow turned lower and gold just kept going higher. So what is this all about? Well, when the news first broke on CNBC, there was some celebration over it, and the market was green, and they were very excited. But before getting on here with you, I turned on CNBC, and they were actually angry because the Dow was red, and they were saying that the Fed made a mistake, that they shouldn't have cut rates. They seem to always react to the short-term gyrations of the financial markets. And I think we should just step back for a minute, not always obsess about what the stock market is doing, because I think it's safe to assume that the Fed did not lower rates today because of the stock market. If there was no reason for them to do it just because of the stock market. I would assume that there's things out there that the Federal Reserve knows that we do not know. Perhaps the economy is already in some sort of a recession, and they're reacting to that. Then there's a meeting that was going to be scheduled for around March 18th. I think that's the exact date. And everyone was expecting them to cut then. They're just doing it ahead of time, and they're probably going to still cut at that meeting. But there is a definite feeling of uncertainty out there. That's what I think I was seeing on CNBC when they're expressing doubt because the market's in the red. The stock market action is creating an uncertain environment for people participating in the market. However, I do think that the panic we saw last week, particularly on Thursday, represented a flush out of margin players. And with the Fed acting as it is, I think, I don't think we're going to see a repeat of what happened last week this month, probably not next month. And we'll have to evaluate things after that as they unfold. But definitely uncertainty, I think, is one of the dominant feelings people have. And this action today sort of contributes to that, because we have to ask ourselves, why does the Fed know something that isn't in the public news about the state of the economy? And it was a year ago that the yield curve inverted at last August. Historically speaking, within 6 to 12 months, a recession starts after a yield curve inversion. So here we are, and forget about the virus news. We're kind of set on track to, if economic data is soft, to do what the yield curve said was going to happen anyway. And of course, the yield curve stabilized, but then inverted again last week. And now it's obvious, no matter how worse or better the situation with the virus gets, we are seeing a global impact of that in China, and all kinds of supply chains disrupted. It's impacting the global economy. We don't know how much, but the Federal Reserve knows that kind of stuff better than we do. So I think it's safe to assume that this is not an act they did to make the stock market go up, because it's already going up, the one about the global economy. And to further back up that notion is that before the market opened, there was news, actually linked to it in my email update, that Jerome Powell, the Federal Reserve Chairman, Steve Mnuchin, the Treasury Secretary, were in contact with other central bankers to discuss the situation and how to coordinate together. So that might be what is about to begin. And in fact, the Australian Central Bank cut rates before our markets open. So this happened, by the way, in the first quarter of 2016. There were global synchronistic actions by various central banks when our market fell 20% from a July 2015 peak to a first quarter 2016 low. The Bank of Japan launched a massive QE operation. Our central bank did one of similar size. But now we are looking at future rate cuts. This is probably just the beginning of more rate cuts to come. I would like to take a day or two to evaluate that, to just figure out what is the pace of the cuts, what are the various markets telling us. But one thing worth pointing out is that this is what the Fed is reacting to. On my screen here, these are the different interest rates that the Treasury bond is paying. The 10-year at 1.1%, the lowest point since 2008. And that's what the Fed is really reacting to, this collapse in long-term Treasury yields being influenced by traders. And even with the cut, the 3-month yield is still going to be, and 1-month yield is still going to be below that 10-year yield. So that's what they're reacting to. The bond market and what people are doing is saying it's not just stock market weakness that makes people buy bonds, but their perceptions and expectations of the economic future. And that's it was already sort of weakening before the stock market tumbled. I would argue that the stock market and the bulls in the market just were ignoring what was going on, and then reacted last week, perhaps overreacted last week. But it doesn't change this feeling, and I saw it today, just minutes ago before starting this video, that there's uncertainty seems to be the definition that people are feeling. Well, I want to tell you that there is something that is certain in this environment. And let's take a look at GLD, the ETF for gold, up year to date, up 3.5% around noon today. And it was up substantially last year. It's been outperforming the S&P 500 now since October of 2018, which was at the start of that last 20% tumble that happened in the stock market. Gold is something that I own, and I think is the best way to profit from the markets this year. It's difficult to put 100% of your money in anything because it's easy to get shaken out when you're so invested. Your emotions get too caught up. And you can see this move in GLD, no doubt, shook people up. When it plunged, that was a shakeout. Now, boom, straight back up. And the same thing is happening with gold mining stocks, GDX, the gold stock ETF. Talk about some shakeouts here. It made a new high for the year, and then that was before last week, and then boom, straight down last week, down below 26, and boom, straight up today for an almost 7% gain at 12 o'clock. We'll see where things stand on the close. But GDX was up 38% last year, while the S&P 500 was up about 27%. Vastly outperformed the U.S. stock market. It's doing it again. There's no reason to think this is just not going to continue for the rest of the year. Gold is what is going to benefit from the future rate cuts that are to come this year. And then after the rate cuts, we're going to see a new round of quantitative easing money operations from the Federal Reserve. That's going to become the next giant policy. So this is the future. This is what we're heading to. And this is the easiest way to position yourself in something that is going to benefit for the rest of the year and the years to come from lower rates in this more uncertain environment. When things become uncertain more and more, people look for things that are more certain, and that is what gold represents. That's what the trends in GDX, which I own, and I own individual mining stocks, that's what that represents. And I think it's going to be seen that way more and more as the weeks and months unfold. Not very many people are on top of it, especially not individual investors in the United States. Most of the talk is always about what is the Dow doing today? And if it's down a little bit, then they get really crazy on television. But this is a market that is experiencing last week huge volatility. The VIX volatility index got close to 50. The first time it's done that since 2018. That February, the Dow fell about 10% almost overnight. Typically, when there is a huge expansion in volatility, the size of the swings in the market in 1 week, like we saw last week, that volatility tends to shrink back before another more sustainable move happens. That's probably what we're going to look at, but it'll be more clear there in the next couple of days. So I just wanted to talk with you about my thoughts about this emergency rate cut done today by the Federal Reserve, what I think it means, why I think they did it, and really it does create an aura of uncertainty, but there are still things certain in the markets, and that's what we need to focus on. So all that said, if you're not on my email list, click the link associated with this video, get on the list, get my updates, and if you're on the list, watch out for the update I'm going to have tomorrow. So good talking with you, and we'll see how the rest of this day shakes out. Now I got to figure out how to stop the video. There it is. So get on the email list. This is the first time I've ever used this software to record. I'm trying to do something that's quicker for me to do, and it seems to have worked. So get on the email list if you're not on it, and I'll talk with you later.